All the talk last week, of course, was about the Fed, what they didn't do, but more importantly, what they're telegraphing in a market. When you look at what's happening in treasuries and you look what's happening in equities right now, that doesn't seem to think the Fed is going to hold rates as high as they seem to say they are.
Well, you could say that, or then you can just listen to what the man had to say at the presser last week when Fed Chairman Powell showed us the dots and shared with us that there would be only one easing this year. It's a very far cry from, 6 that was expected by the market coming into the year. So yes, the inflation number is getting softer and trending down towards that 2% goal that everyone wants to see, and that's really good news. But here's the thing that I'm thinking about. If you're Fed Chairman Powell, are you going to ease so quickly when equity markets are all-time highs, job markets are incredibly strong and robust, and the economy is strong? Because if you were to ease, might it just inflate a little bit more the economy, equity markets, and cause these animal spirits to come back and inflation to come back? And so they're going to go, I think, very, very slowly and very, very cautiously. So you might expect one ease or two eases and then a long pause to see, did it do anything to reinflate inflation?
Yeah, but all this ends up being academic to a certain extent, because we keep talking about what the Fed may or may not do. And the question I guess I really have is, does it matter, right, at least in the here and now, for the economy and the markets? I mean, 25 basis points, even 50 basis points of easing, does that have a material impact?
The U.S. economy is so strong, and the reason why it doesn't have a material impact is because the Fed really doesn't matter. And that's really hard to say. No, they don't really matter, given the amount of fiscal stimulus that's happened. And the fiscal stimulus has been so exorbitant, so huge, never before seen in a growth market like we've had. And yet it came through in trillions and trillions and trillions. I'm talking about Infrastructure Act, the CHIPS Act, and many other acts that added trillions of stimulus at the time the Fed was tightening. So I would say that you're right about that. It is a bit academic, because here we are at higher rates and the economy is just fine. You have to stay bullish because the economy is strong, jobs are strong. Stock market, we're going to see what's going to happen with second half earnings, and we're going to have record earnings in the third and fourth quarter. So I'd say stay bullish for equities and stay bullish for credit as well, because a higher rate environment that we're seeing is really, really bullish for the bond market.